This is a research report from TUM, Technische Universität München. Researchers here in Munich have developed unique data resources and analyses for understanding family firms, companies listed on the stock exchange but strongly influenced by their founding families as a segment of the German economy. These range from businesses like Bauer, an international construction and machinery manufacturing group with family roots as far back as 1790, to companies like SAP and VW. This research now forms the basis of two new stock indices developed cooperatively by Deutsche Börse and the Center for Entrepreneurial and Financial Studies here at TUM.
It is pretty unusual that a stock exchange is creating an index together with an academic institution. This, by the way, is done now for the second time, as we have already created the GEX in the same context. Deutsche Börse is calculating the index day by day, while we are defining the index composition every quarter.
TUM professor Christoph Kaserer is co-director of the research center.
It is pretty clear that family firms are a very important part of the German economy, and by the way, not only of the German economy, but of almost all industrialized economies in the world. So investors might be very interested in having an information about the performance of this part of the economy. The second point is that investors might also be interested in participating in this performance by buying these companies or by buying certificates or other products that are related to the performance.
Determining the most meaningful criteria for defining a family firm has been a significant research problem in itself, according to Professor Anne-Christine Achleitner, the center's scientific director. Digging up hard-to-get data on ownership structures was just the beginning.
If you're talking about the stake that makes a family influential in a company, that stake depends on the capital market system that you have. Now, the CEFs thinks that in Germany you would need something like 25%, which is a bit higher, like what is used, for example, in France, which is 20%, and is very different from the United States, where researchers perceive 5% to be already a considerable stake, allowing the family to have influence.
The second major element of what they call the founding family definition is participation in management or supervision.
We obviously have a two-tier board system here in Germany as compared to the American system with a one-tier. So we would have to look at both parts, the Vorstand and the Aufsichtsrat, in order to decide whether the family has influence.
The researchers have found distinctive patterns of performance and behavior among companies in which the founding families have at least a 25% ownership stake and influence through a management or supervisory board.
What we know from research on family firms is that family firms are more long-term oriented than other firms.
Now you might ask yourself, how do you see this? You might look at R&D expenses, for example. You could also look at other issues like risk management.
We have seen, for instance, during the financial crisis, that the so-called agency problems in listed companies are very important. And by agency problems, we mean the fact that the management of the company is not always acting in the interest of the owners of the company. Now, family firms are a nice example where these agency problems either do not exist or at least they are mitigated, simply because the family is a shareholder as well. So the family has an interest that the company is run in a way that is in the best interest of all the shareholders.
We can't judge how the family firms sail through the whole crisis, because obviously the crisis hasn't been finished yet, so we're not able to judge that. But we have two striking points to mention. First, the level of equity. The equity ratio is much higher than in family firms than it is in other quoted firms. We have an equity portion of 51% as compared to 30%, which I would say is a pretty comfortable cushion for times like these. On the other side, we see, if we look at capital markets performance, that family firms as owner-dominated firms too react more heavily to the crisis. They're more volatile, and there might be different reasons for this that have nothing to do with the governance structure, but with the fact that first, they are smaller in general, and secondly, they are less diversified. There's a higher volatility of family firms will of course also mean that although they're struck more in the downturn, they might be quick in the when it goes up again. So we're going to have to watch this closely.
In the next phase of research, the Center will investigate issues including innovation management, communication, succession, and executive compensation in family firms. In Munich, I'm Patrick Regan for TUM Research Report.